What's up, guys? Today, we're going to be going through a dividend portfolio. This is a list of dividend stocks that pay over 4% and are ones that I think are good enough to be on the list. So there are tons of stocks that pay over 4%, but most of them are going to be real estate companies or energy and utility companies. But the main concern I have with most of these stocks is that their share count, their problem of diluting shareholders is really big at companies like this. So this list has a little bit more quality companies in there, and we're going to go through them, and I'm going to talk about what to look for and what is important to judge one from another. So the first one is one of those real estate companies, and this is Vici Properties. So as you can see, they pay a 4.7% dividend, not bad, but the payout ratio is another one where you have to check that for every company. And for the ones that pay higher dividends, a lot of times it's a problem because they're paying out more than they should be, or more than they're kind of being dangerous with the way they do it, because they can't really afford it, but they still are paying out 100+% of their earnings as dividends. The other columns I have here is how long have they been increasing their dividend for. This is consecutive years. And then since what year have they been paying a dividend? So sometimes it's different depending on the company. And so we'll go through that. But then the last column is probably the most important. That is, what is the average share count that they increase? But what is the average percentage they increase the share count by on an annual basis? So for this stock, for example, it's 31%. That is very bad. That means your value and your investment into the company would be worth a third less of what it was originally 1 year later. So that's not good. Then we have a company like Kinder Morgan. That's like an oil company, a pipeline company. Great yield, horrible payout ratio, and horrible problem with diluting shareholders once again. So that's the main thing we're looking for. Is of course everybody wants a good yield. But that should be one of the last concerns. Like, as long as they're paying somewhat of a dividend, whether it's 2, 4, 6%, that's all great. And obviously you want the higher the better. But if it means the company is going to be at risk of, there's more important things than just a couple percent of a yield. If they're having a huge problem diluting shareholders by 20, 30, 40%, like it is sometimes, that's going to hurt you a lot more than just an extra 2 or 4% in gains from a dividend. The other thing to look for is how long have they been paying that dividend. Some of these companies, I believe the longest one is 3M. 3M has been paying, or increasing, not just paying, but increasing their dividend every single year since 1958. So that's the best one on this list. And that's a very important thing to look for, because that says a lot. But if we get back to this, we can see that here's this company is, the ticker's EPD. This is one I owned before. Great yield, but once again, problems with the payout ratio. But the share count problem is not as bad. But we're really looking for ones that have a healthy payout ratio, something like, if it's like 30%, 50%, maybe even 70%. Once you get 70% plus, then you're starting to push it. That's a little bit too much, because I was listening to a podcast the other day that was talking about how you don't really notice. You notice it when it says, like, let's say they're going to pay out 100% of their earnings in dividends. That means that if all their money is going to dividends, that means that money is not going to other places that it could be, like paying off debt, like reinvesting back into the business, things like that. That is actually going to increase the value of the company, which in turn will increase the value of the stock price. And so those things are more important. That's why we want to see payout ratios like 30% or 50%. That way, the other portion of that earnings is going to be going to reinvesting into the business or paying off debt and making the balance sheet look better, things like that. But you don't really notice that. You don't notice if you don't see the result in the numbers, you're not going to notice where that money goes and what that's actually doing for the company. So although you might be getting a high dividend yield, you're actually going to be suffering from the money that was not invested into those healthier places. So EPD it's okay. But we're looking, so like Scotts Miracle-Gro, this is a good example, I think, because 5% is good. Payout ratio, 40%, that's fine. There's nothing wrong with that. They've been increasing the dividend for 12 years, and their share count is down 1.5%. So far, I think that's one of the best ones. Verizon is another one I've been buying. Great yield, payout ratio of 55% is fine. and then 2% is not that bad. They've been increasing the dividend, for a while now, for what, 17 years. And so what for this column, I like to look to see, it's really impressive if they can pay a dividend or increase a dividend for, let's say, 30 years or 40 years, right? But as long as if they can do it for like 15 or 20 years, and I see that they can make it past like recessions and like really tough economic times such as 2008, that's impressive enough. So Verizon, for example, has been paying since 2005. That's a good number, because that means they increase their dividend even in times of a bad economy. Cracker Barrel is so. I just thought that was interesting, because that, for a restaurant, it's kind of unusual to see them paying such a high dividend, but the payout ratio is not great. Let's see, Whirlpool here. I like this one. It's a healthy payout ratio. Share count's good. Same thing with VFC. This is another stock I bought recently. Now this one, the payout ratio is higher. 87% is not the best. And the other thing to consider here is, let's say that for a stock like this with an 87% payout ratio and a 6% yield, that's a pretty high yield, right? So one thing they could do, there's another company on this list, actually this one right here, B&G Foods, that I own also, and they did this. What they do is, if they're paying out a super high amount in earnings, let's say 80 to 100%, and they have a high yield like 6%, then, or in this stock's example, they were paying an 11% or 12% dividend. In that example, all they did was they cut the dividend in half, pretty much, because this dividend was, I believe, it might have even been higher. It might have been like 12% or 13%, somewhere around there. They pretty much cut it in half, and now that's going to be a lot healthier for the company, because now they're not doing something that they can't afford. So that makes me happy. The dividend is still high, but it's not ridiculously high. For VFC, for example, they could cut this dividend down to, let's say, 4.5% or something, and then bring that payout ratio down and reinvest that money back into the business. The other thing I like here is that they've been raising it since 1974. I believe the company is like 120 something years old. That's another thing I like to see. So that's why I'm happy with that one. That's why that payout ratio is not the best, but they have other things to offset it, kind of. Amcor is one I've owned before. Not the best payout ratio. What else do we have here? This is supposed to be Hasbro. Hasbro, I never owned that one. They've been increasing it for a long time, but not a great ratio. What else? AT&T is always, a good one to look at too, but that payout ratio is really bad. So we don't want that. Once again, they haven't been increasing it for very long, so that's not the best sign. This one is a little bit different. This is an exception, Coterra Energy, because it looks like they just acquired a company. They merged with another energy company, and that's why this says 177% of a share increase. If you look at it, they're somehow paying a 9% yield with only 46% payout ratio is very good. That one we're going to have to keep an eye on. We're going to keep an eye on it, because I don't know. We'll have to see how this merger kind of looks going forward. I like Best Buy. Best Buy has a 4% yield, one of the lowest payout ratios you're going to find on this list. They've been paying it for 20 years, increasing for 20 years, and their share count's down. I like Best Buy. I think that's a good one. B&G Foods, B&G Foods and Arbor Realty Trust are two that I bought a lot of this year, because I was so attracted to that 10 or 12% dividend. It looks great. But when you go to see their return on invested capital, how profitable are they? Is the business growing? Are they diluting shareholders? They do really bad with all those things. As you can see here, ABR, I sold ABR today because the numbers just don't add up. I don't think the stock price is going to go much higher. And even though you're getting a 10% dividend, it doesn't look good. Now, one thing I will say about real estate companies is it looks like, since these companies pay out such a large portion of their earnings in dividends, I believe to qualify as a REIT, I read that you have to pay out at least 90%, have at least a 90% payout ratio. I don't know how true that is. I don't know if that's the case, but the other thing is they say that in order for the real estate company to have more money to invest into more properties, they do that by raising money from shareholders. In other words, diluting shareholder value. And that might be one thing, but I don't think that's still not a good excuse to, have your be losing a ton of money from the shares just because you're getting a high dividend. So, you got to watch out for those things. But B&G Foods, not the best. ABR, I would say these two are dangerous, even though, because look at those, the share counts are not good. They haven't been raising the dividend for very long. The payout ratios are bad. And go look at what numbers they do. The company doesn't grow because they're not. Well, ABR is a little bit better, but B&G, their profitability is bad, and they're not growing. ABR, their profitability is a little bit better, but their return on invested capital is only like 3% or 5%. So they're not getting very good returns. Walgreens, I have a bunch of this one. I love Walgreens. Great yield. Payout ratio is fine, and they've been raising it since 1976. Same thing with 3M. I own a bunch of this one. Pretty similar numbers to Walgreens. So those are the important things to look for. Look for those companies like that have been paying now for decades and decades. They've been raising the dividend. Their share counts, they buy back shares. They're not issuing a bunch of shares and hurting your shareholder value. Those are important things. And then, is the payout ratio healthy? Right? If it's 100% or 150%, that's not sustainable. That's going to that means your share price is going to go down a lot because that business is going to be in a bunch of debt, or that means that dividend is going to be cut. And in that case, that would be a good thing. That's a different story. If they cut the dividend and the payout ratio comes down to 60%, then that's fine. But they should have done that a long time ago. So that you don't want to be in that position where they're paying, 150% of earnings. But that's my list. And, some of my favorites on here are 3M, Walgreens. I like Best Buy, AT&T, I guess. VFC I like. Verizon is very good. I think Scott's Miracle-Gro is good. And those are some of my favorites. So thank you for watching. If you guys know any really good dividend stocks, comment down below. I'm interested what you guys think. And I'll see you in the next